And joining us for a closer look on what's playing itself out in that market scene is Chantal Marx from F&B Wealth and Investment. Chantal, always a pleasure. Good afternoon.
Hi, yes. Well, it's a pleasure to talk to you, but it's not a pleasure to be looking at my screen right now.
Yes.
It makes for some pretty depressing reading.
I mean, what is happening, Chantal? It's red screens all around. Europe not doing any better. We know the United States back online today. China back online after that long week. But it's just been weird.
Yeah, I think that we'll get a better sense of market direction after the US opens late this afternoon. Obviously, when the US is closed, volumes tend to be under a little bit of pressure. There's also a lot happening this week. And I think from a South African perspective, perhaps investors waiting and seeing what's going to happen with the budget on Wednesday. And then internationally, I think there's going to be a lot of focus on NVIDIA's results that are out tomorrow night. So it's going to be a very, very busy evening for market watchers tomorrow and probably overnight into Thursday, because NVIDIA and that result will likely dictate the direction of the AI thematic trade, as well as the broader US market over the next few months.
I'm actually keen to find out what markets want to hear from the finance minister tomorrow, Chantal. Anything specific?
Well, I think that that investors and economists are well aware that the finance minister is in a very precarious position. We have revenue under pressure, particularly because of corporate revenue receipts. We know that the mining sector has been under a lot of pressure, and in the years before now, probably the 2 years before now, we actually had some really nice support coming through for the fiscus from high profitability within the mining space. Expenditure, even though it's been increasing, not by by a huge amount, it's still an issue, particularly when you look at the expenditure on the interest bill. So I think it's going to be very interesting to see what the plans are for reducing debt, whether or not we will get into that reserve fund that is at the Reserve Bank, and otherwise, what is going to be the plan? Are we going to increase taxes, by extension placing consumers under even more pressure and potentially hurting economic growth? It's a difficult balance. I'm really not sure what he's going to present tomorrow.
It is a very complex one. Another complex one is what's happening in China. We heard overnight that they're trying to sort out issues with that a 5-year rate cut. It hasn't been received as well as I think they anticipated, Chantal. Keen to get your thoughts here. It's just not the kind of stimulus that markets are looking for.
Yeah, so this is the lender prime rate, and it's actually an average of the 20 biggest banks in China and what they are charging customers on a 5-year basis. So even though the People's Bank of China has a heavy hand in that specific rate, it's still a risk management exercise from the bank's perspective. And they also are in a position where they need to protect their margins, because you don't want an unhealthy banking sector either. It's a very delicate balance. The 1-year rate was also kept on hold, and that's kind of very similar to the benchmark interest rate that we'll talk about from a South African Reserve Bank perspective, or the US Fed funds rate. And that specific interest rate was kept steady, even though the market was thinking perhaps we'll get that stimulus coming through. I think that so far, stimulus measures both from the monetary authorities and the fiscal authorities in China has been carefully considered, but perhaps a little bit light in terms of what the market thinks is required to stabilize the property sector and kickstart economic growth in the world's second largest economy.
I mean, we must also speak about, I think, Kumba while we speak of China. Kumba actually, I think, have done okay. And I guess that's because in the latter part of 2023, that iron ore price began to recover. However, they're also talking about job losses. In fact, the mining sector, Chantal, is bleeding jobs.
Yes, I think that's something that we saw in Amplats' results as well. And I think definitely something that's coming from the group overall. My thinking around Anglo-American at the moment is that you do have Kumba that's performing better than expected, and their iron ore assets generally is doing quite well. You have long-term copper prices that will probably be supportive. A lot of confusion around what pricing is going to look like in the PGM space, and I think hence the pressure on Amplats to really kind of tighten up its operations and reduce headcount in order to reduce costs. And then you have the diamond segment in Anglo-American, which I think is overly complicated at the moment because you've got these synthetic diamonds coming through. Adoption of synthetic diamonds is increasing. In fact, there's kind of like an underlying swell of people preferring synthetic diamonds to mine diamonds, and that's going to have a huge impact on the group over the long term. So I think there is a lot of pressure on Kumba, even though they're performing well, even though the iron ore price has been supportive and they've actually been able to realize prices well above benchmark, to also tighten up as much as they can, because it could be a difficult couple of years for that group specifically.
An interesting dynamic about Chantal, about mining, Chantal, is, mining is a very, almost want to say, it's kind of a definite business. It doesn't grow much. The ore body, it has what it has in it, and investors need to then get a return on it. You know what I'm saying? It's unlike a business that you can maybe expand. I'm wondering if that's why, even though we are hearing of these job cuts, we are seeing still a push through for dividends, because you don't have a finite amount of time to reward investors for the ore bodies.
Yes, and mining companies globally have been under-investing in new capacity. So basically the thinking, I think, from the mining companies is, well, we were in so much trouble back in 2016, and then taking a little bit further back towards the early 2010s. From a debt perspective, we don't want to spend money to increase capacity. And in some way that could work, because if you've got a chronic undersupply of these materials coming to market, it will push up the price. The problem is just that it's not a sustainable way of doing business. You have to think about the long term. You have to think about life of mine. You have to think about capacity gains. And I think that the reason why shareholders are pushing for shareholder returns and for cash returns is because they don't see where that growth is going to come from. You then have additional complications like a really weak China, some big thematic shifts like the shift towards synthetic diamonds and electric vehicles that also have a pronounced impact on some of these specific commodity prices. So yeah, I mean, I think it's a complicated business to be in. I personally enjoy mining stocks as kind of trading opportunities more than something that I hold for the very, very long term. It's not defensive, it's super cyclical, and it can hurt you quite badly.
I also want to touch on SuperGroup. Of course, SuperGroup, I think more than 50% of their revenues are actually generated outside of South Africa. So it is a bit of a rand hedge. We are seeing group revenue being expected to have risen 12%. I'm not sure what to make of that, considering that it didn't trickle down to the bottom line.
Yes, so the revenue was supported by a weaker rand, but there were some very specific issues in some of their businesses. I mean, things went pretty okay on the Australian side and in the SA fleet side, but they had some real issues in UK dealerships where margins on used vehicles were squeezed spectacularly after the 2020 run in used vehicle prices globally. That is actually something that we saw coming through in We Buy Cars results as well, just as an aside. And I think that is something that could reverse in the next year or so. They've also spoken about the real strain that they've seen in the German economy, and that's come through in the German kind of macroeconomic data points as well. We know that the German economy is struggling right now. SuperGroup has quite a big business in that space, and if there's nothing for them to move around, then they come under pressure. If competition is high because not enough goods are being moved around to justify all the operators in that space, margins come under pressure. And I think that that's where the pain was really felt. But I mean, SuperGroup is an exceptionally well-run business. They're highly cash generative, very strong balance sheet, trading at an unbelievably low multiple, particularly if you strip out the listed Australian business. So, I mean, I still like this company from a long-term perspective, but I acknowledge that pressure, I think, is going to come through in this reporting period.
Then with the little time we have, also want to touch on Vukile going on to raise that 1 billion rand via an accelerated book build. Very interesting to see, property companies raising money in this way. It is also equity. It sounds like they avoided debt. It is a time of expensive money.
Yeah, I mean, it's actually it's like deja vu to see an accelerate book build from a REIT at 5 o'clock in the afternoon, because we used to see this almost every second day when in the heyday of the REIT market in South Africa. Vukile, I think Vukile has outperformed the rest of the South African REIT space. So its share price is actually at a pretty decent level. So it makes sense for them to raise equity, because you don't want to, as you mentioned, raise unnecessary debt if you've got that equity lever to pull when interest rates and funding costs are so high. They've indicated that they've got a very attractive growth pipeline. It's one of the reasons why we like the company so much. And I think that this book build was very, very successful. There has been some interest coming back into the South African listed property space. I think it's still a really good time to invest in the sector. We have seen some of the operating metrics kind of level out and improve over the last 6 months or so. And perhaps this is just a taste of what's to come at 5 o'clock on a random Monday afternoon on SEN.
With that said, Chantal, which stock are you loving today?
Yeah, so I mean, I was actually having a little bit of trouble with this because, wow, MTN looks so interesting right now. The RSI is dipped below 30. It's completely oversold. It seems as if everything in Nigeria and the Naira is actually being priced into estimates right now, but momentum is still firmly to the downside. So the other stock pairing that I actually like at the moment is Naspers and Prosus. Tencent, I think, is very, very cheap at the moment, but there's a lot more news flow coming out around Tencent and how different it is to Alibaba and the rest of the Chinese tech space, given that it's so well diversified. With results coming up in the next few weeks, I think that could be a nice catalyst for Tencent. So I'll put my money behind Naspers and Prosus.
Fantastic, Chantal. Always a pleasure chatting to you. Thank you so much for your time today. That was your midday markets update with Chantal Marx from FNB Wealth and Investments.